My lollipop.
Your name Mary? Well, Mary, let me tell you a story. Once there was a girl named Dorothy, and she lived in the magical land of estate tax. And she was told that a wicked witch was going to cause a huge estate tax. And in fact, I was saying, oh, that's nice. Well, you have to listen to the story. It's very important. So Dorothy thought there was going to be an estate tax, so she was very, very frightened. And she was going to put her house in a qualified personal residence trust, but a storm put it right over a wicked witch who looked like Nancy Pelosi, actually. So she was very frightened that they were going to confiscate even her basement. And then she woke up on Thursday, and it was all a dream because President Biden didn't even have a state tax on his list of possible taxes. Did you know that?
Yeah.
Did know that, right?
Yeah.
And what is your favorite tax, little girl?
Lollies.
Walgreens is your favorite tax?
Yeah.
Lollies.
So anyway, if your mommy and daddy are going to be worth more than $11,700,000, this needs to be addressed as soon as possible, okay?
Okay.
And if you receive a gift exceeding $15,000 in a year, you need to make sure that whoever gives you the gift gives you more as soon as possible. Do you know what a 529 plan is?
Yeah.
What is a 529 plan?
What is
I'm gonna
say that to go to college?
529 plan is to go to college, and someday you'll also have a 6 and 678 trust. So thank you very much for hosting our webinar. I'll be sending you a very big check, which you can put into a Roth IRA, okay? When you get the check, endorse the back towards the top, but don't use your crayon anywhere else. And say, hello, everyone. Welcome to the webinar.
Hey, I'm going to
Can you say bye, Papa?
Bye.
Hi. Okay. Welcome to a celebratory webinar. We are very pleased to let you know that on Thursday, President Biden announced a speech that he would start at 10:30, and he was a little bit late. I think he started about 10:50, and he did not mention the federal estate tax. And I had one of our law students watching, and I told him, as soon as he mentions the federal estate tax, get me out of my meeting. Well, there was no mention of federal estate tax. And then shortly thereafter, there was a White House bulletin that came out on the proposed plan, which apparently President Biden felt he had a deal with 50 senators, which can't be easy. And that plan calls for an expansion of the 3.8% Medicare tax to those of us who receive dividends from S corporations and partnership distributions, and that's going to be a little bit painful. And he also is calling for a 3% tax on income exceeding $10 million. So those of you, not us, who receive more than $10 million of income in a given year, thanks for your contribution of that 3%. There was no tax on billionaires. I think they probably have some influence with at least one U.S. senator, believe it or not. When I say my senator, I mean the senator of my state. When a billionaire says my senator, he probably means that he or she owns the senator. I don't know. I've never been a billionaire in a room with a senator. But in any event, if you can still bear to watch this, to make a long story short, the estate tax exemption is $11,700,000. We expect it to stay that way. Now, this could change. The tides could run back and forth. They might swap something for something. But we believe that it is, the bear and I, by the way, when I say we believe that it is very unlikely that the exemption will not go up by inflation next year. So it'll probably hit 12 million. It will not go down to 6, as was proposed by the House Ways and Means Committee on September 13. It just doesn't look like they have the votes to make that happen. They also did not make mention of any of the other estate tax related items. So qualified personal residence trusts, no mention. Grantor retained annuity trusts, no mention. Grantor trusts, which are disregarded for income tax purposes, one of our favorite things, no mention. So it looks like the coast is clear. Now, the interesting thing is that a lot of planners had a lot of clients, and it was well advised, go ahead and make large irrevocable gifts to irrevocable trusts, and it's been done. And it should have been done. But the clients may now be thinking, wow, should I have done that? I didn't really need to. I've got a $12 million exemption next year. Maybe Trump will be reelected and the estate tax will go away completely. Well, most of our clients instead did the Biden two-step because we like music. By the way, I was just listening to a really good audio. If you ask Alexa to play Martin Mull folk music, he has a really good talk about folk music, although he says it's rather boring. To my talk, I don't remember where I was, so I'll go to slide 2. Well, by the way, a bartender, a guy walks into a bar and there's a bear, and the bear is cleaning his private parts. So the customer says, man, I wish I could do that. And the bartender said, well, before you do, you should like pet him and get to know him so he doesn't bite your head off when you try that. Okay, if you didn't understand the joke, send me an email. I'll explain it later. And you've got my email address here. It's agassman@gassmanpa.com. And if you send me an email and you put bear, B-E-A-R, in the RE line, I will send you a free book. I'm not sure which book it'll be, but you might enjoy the book. By the way, our Thursday report goes out every other, guess what, Thursday, except yesterday we ran late. It was a Friday report. If you'd like a copy, just send us an email, put Thursday report, and we covered, and from there you can click to our Forbes articles that we have already gone ahead and put up on our Forbes blog for these new law announcements. And those are here on page 3 of your PowerPoint. And in the Forbes blog, I discussed that I thought I was Noah, helping all the people get onto the ark to save them from the estate tax, and I became Chicken Little because the sky didn't fall after all. But guess what? If you have assets in the $7 to $8 million range, you'll be at $12 million before you know it, unless you start spending more. Go ahead and spend that inheritance or do unwise things to save that estate tax for your children. Now, on page 5, I have given you, Brandon helps me a lot with this. He does all the hard work, I do all the easy work. But net investment income in the United States of America is subject to a 3% tax, and this tax is not tax deductible. So while they tell you you're in the 37% bracket, you're actually in the 40.8% bracket if you have net investment income. Now, if you're single and you're not married, then the first $400,000 of taxable income won't count. So if I have a salary of $300,000 and I have dividends and interest and S corporation dividends and interest of $200, salary of $300, dividends and interest of $200, then I'm at $500 in total income. I have to pay the 3.8% net investment income tax, also known as the Medicare tax, on 100,000 because if I'm single, because Marcia divorced me because I kept the cabinets open. Now, on the other hand, because we're married, I have a $500,000 exemption. So if I have 400,000 salary and 200,000 of net investment income, then it's 100,000 over the 500. So what a lot of people do, including Joe Biden, and by the way, I'm not criticizing or supporting any politician, I just mentioned them. Joe Biden apparently has a lot of S corporation income for consulting. Now, if her S corporation paid her a salary for the work she does, then that is subject to employment taxes. But when it pays her a dividend, that is not subject to employment taxes, and it's not subject to the 3.8% Medicare tax, but it will be under the new rule if they have over $500,000 of taxable income, and I believe that they will. So one moral of this story is, if the tax rate for corporations is not going up above 21% and you're setting up a new business, do you make that S election so that all the income flows through to you at the 37%, or actually after the Medicare tax, the 40.8% bracket, or do you go ahead and set up a C corporation that will only be in the 21% bracket? Now take into account your C corporation will also be subject to tax on you. I'm sorry, the C corporation income stays in the company. When it comes out to you as salary, you pay employment tax. If it comes out to you as dividends, you pay a dividend tax and the Medicare tax. So accountants are going to be very busy before now and year end. But if you thought you were going to set up an S corp, don't file your Form 2053 S election until the 90th day, which is the deadline, and talk to your tax advisor before then if they're not on vacation, and find out if they still recommend that you make the S election. And there's, oh, I got it wrong. It's going to be a 5% surcharge if your income is over $10 million. That's not your estate, that's your income. And then if you have a trust that's taxable on its own brackets and it has income retained in the trust, then that's going to be a 5% extra tax on everything over 200,000. And we go into significant discussion here. And then the good news on page 9, no increase in personal income tax or capital gains tax. The estate tax changes came completely off the table. By the way, this is all from the White House report. It's available on the internet, which was invented by Benjamin Franklin. Proposals to increase and compress the tax rate brackets did not get through. Proposals where if you died, you wouldn't get a new income tax step up, that didn't go through. They did nothing about the fact that you could make your grandmother a beneficiary of your trust, and when she dies, get a step up in the basis of the trust. The threat to tax large IRAs did not get through. There was one proposal to impose an extra 2% tax on people who had cats. That did not get through either. Now, if you have a raccoon, you might worry, but at least for cats, if you have a cat, your tax rates are not going up. So then we had the Biden two-step. There was no change to the estate tax whatsoever. So if instead of gifting those assets to the irrevocable trust, you sold them to the irrevocable trust for a low interest note, which is what we recommended for most clients. Now, if you think you're in the clear, you can unwind. If the values are the same, go ahead and forgive the note and get the assets back. So, but on the other hand, I would just keep it in place because your excess growth is going to go into the trust, as you know. Now, if you're a CPA or lawyer, not only does this presentation not qualify for continuing education credit, but if the accreditation authorities find out that you attended this presentation, they will take other credits away from you. Also, approximately 2 to 3 hours after I'm finished, which will seem like a long time from now, you will all receive an email with a webinar recording of this webinar, or at least a link where you can go watch it on YouTube. And all of our webinars are on YouTube, and we get 1/2 of a cent every time you watch them. So if you could watch one of our webinars 1,000 times, we would get 50 cents, and I would really, really appreciate that. So the first row of our webinar page is our webinars that we've been giving on Saturdays on estate tax, and some of them have silly puppets. The second row is all charitable, because I've been working on a lot of charitable presentations this year, and that's what the second row is. The third row is miscellaneous, business, and things like that. Across there, these are not real people. They were bought by clip art. I'd like to tell you that this is my staff, but they are not nearly this attractive. Okay, on Thursday, November 4th, I'm speaking for 2 hours for the Estate Planning Council of Birmingham on innovative charitable planning techniques. If you would like to see that, we will record it, and I can make the recording available for you. And my partners, Brandon, Chris, and Ken, are all going to contribute to the effort here to try to make charitable planning easier to understand for experts, for tax advisors. It is way too complicated. So we are concentrating on what you can do and not necessarily what you can't do. In the not so free category, superhero Jonathan Blotmacher, who I refer to as the #1 estate planner in the United States and the #1 tax thinker in the United States, and I will be speaking for Lineberg Information Services on Florida snowbird planning. Now, this is in the not so free category, but if you want a copy of the PowerPoint, I'll be glad to share it for you. And this is going to be on November 5th from 3 to 4:30 p.m. And Jonathan is very entertaining, very, very fascinating. I always learn a lot from him. And I'll also be speaking in Washington, D.C. for the Florida Institute of CPAs, et cetera, et cetera. Now, let's go forward and just let you know, because we do have some new attendees here, and we've got 3 Excel spreadsheets that you're receiving from us, and these are still usable by you. So where are we here? Here's the spreadsheet, and you don't have to know anything about spreadsheets to use this spreadsheet because they have arrows. So you see the arrows and you see the spreadsheet, and here we are with a married couple. You can tell they're happy because they're still married. I'm green with envy, so the married couple is right there. And this tells us on number 3, this is the estate tax exemption. It's $23,400,000. Now, this is number 4, yellow. I'm cowardly and afraid because it is scheduled to come down to half of the otherwise applicable amount in 2026. So if the Republicans can't raise it or the Democrats can't lower it, this is where we're going to be sitting in 2026. So you won't want to be in intensive care if you're wealthy in December of 2025. Because just think about that. It was just like in 2009. Do we let Grandpa go or do we keep him alive? Well, if you were in 2010, you needed to die in 2010 to avoid the estate tax. If you could have made it to 2011 and died on January 1st, then your family would have paid a big estate tax. So this is going to happen again in 2025. Blue is what was going to happen. It was going to be cut in half beginning next year. That did not happen. So here's your married couple. They're perfectly happy. They're in white here, very innocent. And let's say that their net worth is, let's go up to 11 million. And let's say that they're going to grow that net worth at 6.75% a year is what their assets are going to grow at, and that they're going to save $100,000 a year for 15 years. So I just did that setting. Now, it's interesting. Here's where they're going to be in 15 years. They're going to be at $29 million. Now, if they could save just another $10,000 a year, I'll click that to $110,000 a year, then they would still be at $29 million. So the difference for if they could save an extra $10,000 a year is about $200,000. But if they could save another $50,000 a year by selling the boat, which they hardly use anyway, and not having to insure it anymore or buy fuel, then they'll be at $30,773,000 a year. So if the estate tax stays the way it is, they don't have to worry about estate tax till 2017. They just have to die before 2016, and there won't be a problem. But if the exemption goes to half in 2026, their estate tax will be $8.6 million. And that may be a little bit upsetting. So they can use the Estate View software now. So I can bring that here. And I can go ahead, I've creatively called them Bob Sample and Mary Sample. And I can say that their business and investment assets are 20 million, up to 20 there. Oh. And I can say, well, let's go down to 15. Go to 15 million. And then I can say that they are going to have their lifetime exemption go into half in 2026. So that's what I just did. Just move this over here to a full fit, please. Hey. And then I can provide that there will be no portability allowance. So in other words, when one dies, there will not be an addition to their estate tax exemption. I can assume that the bypass trust on the first death will be $7,800,000 and that they will do no gifting. So what happens here? I'll push that. Okay. So what happens here? 16 million, and oh, I've killed them both in year one. That probably is not what they want. Here we go. So the first dies in year 10, the second dies in year 20. So Bob and Mary have 16 million of investments, and they're going to grow those at 6%. Oh, I've got them at 11% a year. I apologize. Let me get that down to believable. I'm down to 5.8% a year. So on the first death, Mary has in year 10, $24 million. And on the second death in year 20, Mary has 38 million, and Uncle Sam receives 11 million, and the children get $27 million. Now, if you do the estate planning properly, on the first death, based upon the exemption going down to half, and they do no other planning, then on Bob's death, and we always kill off the husband first. It's just a happier story that way for the wife. So on Bob's death, instead of Mary getting everything, $7,830,000 goes into a credit shelter trust, also called a bypass trust. It benefits Mary for her entire lifetime. It is never subject to federal estate tax when she dies. Mary can be the trustee. She can get what she needs for health, education, and maintenance. And then on Mary's death, it goes not only for the children, but it can be held for their lifetime health, education, and maintenance. So on that second death, 12 million passes passes in the bypass trust. If they have 3 children, that's 4 million per child if they like them equally, or if they like one more than another, that's fine. But that child doesn't receive the money. They are trustee of a trust, and they are able to hold the money, invest it, receive what they reasonably need for health, education, and maintenance. And then it's not subject to their creditor claims. It's not subject to divorce claims. and it's not subject to estate tax when the child dies. This whole thing about give them half at 30 and the rest at 40, I think any responsible 30-year-old and any responsible 40-year-old, if there are such thing as responsible 30 and 40-year-olds, they tell us, no, I don't want to inherit it. Put it in a trust. I'd rather use it for my children. I want to know it's there. Don't always get along with my spouse. Surprise, surprise. A little bit concerned about a divorce. Surprise, surprise. So just a little bit of careful wisdom there. Now, so what did this do? This cut the estate tax. With no planning, the estate tax was at 11 million. Using the bypass trust, I've got the estate tax down to 6 million. Now, what else can they do? I said they have 3 children. So we can go to gifting here on the left-hand side, and they haven't done gifting before, but let's say that they're going to have 3 children and 2 grandchildren who they love more than their children, by the way. As you can see, I love my granddaughter. So they could gift $15,000 a year, and that's going to go up with inflation. Times 5 is 75,000. While they're both alive, it's 150,000 a year. After Bob kicks off, it's 75,000 a year, inflation adjusted. So now I go to my annual gifting module. I click on annual gifting, and look at this, the time value of money. Einstein said, allegedly, that there is nothing more amazing than the time value of money. Of course, later it was proven that Einstein didn't say that and probably didn't care much about money because money couldn't buy him love. Or was that somebody else who said that? I'm not sure. But anyway, look at this. 150,000 a year, growing at 5.9%, and the trust does not pay any income tax. Hooray! Who pays the income tax? Bob and Mary, because as most of you know, when you set up an irrevocable trust, you can set it up so that there is no income tax on the trust and no gift tax on the fact that Bob and Mary happily pay the income tax. So that trust in a mere 10 years is worth $2,282,000. That can't be right. I guess it is. Wow. And look at this. In 20 years, it's worth $5,600,000. My gosh. By the way, I can click here to annual amounts, and it should show me, there it is, gifting trust. And there's all the calculations. My brilliant son-in-law, David Archer, put this all together for me. It only took like 1 weekend, maybe 2 weekends, maybe 3 weekends. I could have bought a boat, but instead I bought this software program. But that's the growth that keeps the program honest. Back to trust logistics. All right. So now I've reduced the estate tax to only $4 million. But what if the clients do what all clients do? We forgot to tell you about the property in Montana. It's worth $2 million. Okay, well, got to click here to 18 million. Oh, and by the way, our assets haven't grown at 5.98%. We've grown them at 7.23%, but our investment costs have not been 1.5% a year. They've only been 0.6, and our taxes have cost us an average of 0.7. Wow, you're back up to 12 million, Bob and Mary. Glad to have you as clients. Well, why don't we do this then? Let's set up an LLC, and every year, instead of gifting cash, let's gift discounted LLC interests. So now we're going to show you if we're and we can do this now. We thought we weren't going to be able to, but thanks to Senator Sinema, it's pronounced cinema like a movie. It starts with an S. She's a lot of people's favorite person in the whole world right now because she would not go along with these gift tax increases. We can now discount it. So I put $1.5 million, or I put $1 million into an LLC. The LLC invests in stocks, and I transfer not 15% of the LLC that would be worth $150,000, but 25% of the LLC, or maybe 22% of the LLC. It's really worth more than $150,000, but it's reported at $150,000. So I click here, discounted gifting, and instead of the gifting trust being worth $6.5 million, it is now worth $9.9 million. And the estate tax savings, when you look at this, from $12.898 million, the estate tax is now $11.501 million because of the discounted gifting. Now, I'm not going to get into life insurance just because that complicates things. I'm not for life insurance. I'm not against life insurance, but the program does handle life insurance. We're just not going to cover it today. If you have life insurance, though, maybe we should give them life insurance, but there really isn't time. You want the life insurance in an irrevocable life insurance trust unless you can make sure that you die before the life insurance policy matures. So if you only have a 5-year term policy, may not be worth the cost of putting in a life insurance trust. But if you have a permanent policy, the chances are, if you're estate taxable, you want it in an irrevocable life insurance trust. Well, here I am, and I still have a big estate tax burden. So now we're going to talk about the SLAT. Now, the SLAT stands for a Spousal Limited Access Trust. Bob can take some of his assets and place them into an irrevocable trust for Mary and the descendants. And Mary can be the beneficiary of this Spousal Limited Access Trust. It is called a SLAT. Now, Mary can take out what she needs for health, education, maintenance, and support. And we call that the HIMSS standard. That Mary doesn't sew, but we call that the HIMSS standard. Health, education, maintenance, and support. Mary doesn't have to sew with this kind of net worth, by the way, but she could if she wanted to. So, I meant sew, S-O, not sew, S-E-W. So Bob could take $1 million worth of assets and transfer them from him to Mary as trustee. And what is that going to do? It's going to use $1 million of Bob's $11,700,000 exemption. It's going to reduce his exemption to $10,700,000. But then the $1 million, it's going to double in value about every 10 years at this rate of return. So after 10 years, it's going to be worth $2 million. And after 20 years, it's going to be worth $4 million. And that's going to escape estate tax, even though Mary could use that trust to live on entirely. So it's really a no-brainer to do this trust. So I'm going to go here, and I'm just going to show you if Bob would make a gift right here of $1 million today, then I can click to the gift installment sale module, and you will see when I click the button that now you have a separate trust. The numbers weren't exactly what I told you, but this separate trust, he only used $1 million of his exemption, and it's worth $3.5 million in year 20. And now the estate tax is $10,817,000. So $10,817,000 compared to what we had before, $11,518,000. So that gift saved some significant federal estate tax. And he could give more. You could just say, if I give $2 million, then or if I give $3 million, then my tax is down to $9,400,000. So that would be a good reason to go ahead and make a large gift. If Bob wanted to use his entire exclusion right now, if he wanted to go ahead and make an $11 million gift, because he's very generous, then that would get the estate tax almost down to zero. And that would be $40 million passing estate tax free on the second death. So this is the reason that, yes, Biden didn't reduce the exemption to 11 million. But why would you wait until you're too old to do it? Every year that you have this trust funded is another year where the growth is out of your estate and you are paying the income tax. So it's not only the reduction of your estate by the 11 million and growth, but it's also that little bit of tax that we show you is being paid by Bob. So that's why Bob should do that. Now, Bob says, what if Mary divorces me? Well, I don't know if you'll be happy or sad at that time. Mary will probably be happier once she gets that done. But the SLAT can have a special provision in it which says that in the unlikely event of divorce, and we always use that word unlikely, whether it's likely or not, that's a legal word, I guess. Unlikely, in the highly unlikely, completely unimaginable event of divorce, the SLAT divides into two separate trusts. The first trust continues for Mary's benefit. Mary's the sole trustee. Bob's not involved with it anymore. And as you know, Bob, don't feel so bad because Mary's going to spend it all on the children. You know, so often people get divorced and they're all upset because they had to pay their spouse too much. The spouse just hoards it and leaves it to the children. So is it all that bad? Okay. Now, what happens to Bob's half of the SLAT? Bob's half of the SLAT becomes a trust for the children who Bob loves. And Bob gets to choose who the trustee is, and the trustee could loan Bob money. And if the trust is in Nevada or another creditor protection state, Bob could be added as a beneficiary of the trust. And in that event, the trust could pay Bob an annual amount, a percentage of the trust, which we call a unitrust. So then it would be a spousal limited unitrust, also known as a SLUT. So definitely you start with a SLAT. If you get divorced, it changes. Probably not such good humor, sorry. Okay, now I want to show you the Biden two-step. Bob says there is no way on the face of this earth that I'm putting $11 million into some trust. I'm just not going to do that. Okay, Bob, we have another idea for you. We're going to have you put, let's say, $1 million in the trust and have you go ahead and put, oops, lost that, $1 million in the trust and then put $7.5 million into an LLC. And then using a discount of approximately 1/3, also known as 35%, we know that let me go to 12 million here. So you put 12 million in the LLC, take a 35% discount, Bob. Your 99% non-voting member interest in the LLC is worth 7.8 million. So you put in 12 million and you sell an interest worth 7.8 million to the trust, the SLAT. And what that does is it reduces your estate by the difference between 12,038,000 and 7,825,000. So that's a pretty good reduction right off the bat. And the House of Ways and Means Committee was trying to do away with this. I can't imagine why. The other thing this does is, what's the interest rate on this note? The interest rate on the note is going to be, if you do it right now, 1.75% approximately. So Bob, instead of having $12 million in your estate growing at 7%, you're only going to have a note for 7,800,000 growing at 1.75%. And then the third thing, and this is the other thing they were trying to take away from us, and it was so mean of them, I was so sad, was, Bob, you're going to pay the income tax on the growth of this $12 million portfolio without that being considered to be a gift. So what does that do? Well, before we do this thing, we're looking at a large estate here, 52 million passing to the beneficiaries, but they're still very sad when Mary dies. Why are they sad? Because they lost Mary and they lost $11,501,000. Not sure which made them sadder. But when we go to the installment sale, if Bob would put $1 million into the trust, the SLAT, and then 12 million in an LLC, take back a note for 7,825,000, knowing that he and Mary can live on that SLAT, it can pay half of their expenses, half of their taxes, all of Mary's expenses after they die. Click on installment sale, and the estate tax is 0, and the children are so much less depressed on Mary's death. In fact, this was more than they needed to do. Let's look and see by time frame what happened here. We reduced the estate tax to 0. What you have on the bottom is the installment sale trust became their largest asset. And the green assets were the assets that they had available to them. And the bypass trust is the dark green, and the gift trust is the yellow. So they definitely didn't need to do as much here. So that assumes a low growth rate. So we could have sold a lot less, but see, if we had sold only 10,500,000, then you would have had a little bit of estate tax there. So we didn't miss the mark by that much. But if they have an annual income that they're saving an extra $250,000 a year during Bob's life, well, let's say they're saving $500,000 a year during Bob's life, and after Bob's death, because Bob's income will be gone, Mary will only save $100,000 a year. Well, then they have to do more of a sale or more of an initial seed capital gift. It would need to be, wow, a lot more. It would need to be 17 million. So anyway, that is what the estate tax is about. And we've only covered one technique, really. Well, again, we covered 4 techniques. We covered, first of all, if they die today, no estate tax, they are under 20 million, nothing to worry about if they die today, enjoy your vacation. You can both fly on the same plane. But if Bob lives only 10 years and Mary lives only 20 years, estate and no planning, estate tax 28 million. Now, this takes into account no portability allowance, and that's unrealistic. So let me click here. Let's talk about the portability allowance. That's this check the box here. When Bob dies, if he leaves everything to Mary, then Mary's estate tax exemption is not only her 11,700,000, but she gets Bob's exemption. But if Mary, so we assume that she has the portability allowance here. Assume portability allowance. So with the portability allowance, her exemption allows the estate tax to be 28 million with portability. Without portability, 25 million with portability. Because if Mary remarries, then if her new spouse dies before her and does not have a portability allowance, because that new spouse leaves everything to his children and uses up his portability allowance, then there'll be a bigger estate tax. So that's why we want to leave that bypass trust on the first death, so we don't have to worry about the portability allowance. Plus, the portability allowance doesn't grow with inflation. But here we're showing Bob dies after 2026, when the exemption will be half. So we're figuring in 10 years with inflation, it'll be 7.8 million. But if the exemption does not go down, if it stays up and in 2026 it doesn't go down, then the credit shelter trust can be higher, and we can adjust that upward here somewhere. Is it? Well, take my word for it. Forgot where the, oh, there's the upper there. We'll give him an upper. That used to mean a pill that gave you more energy. But now it means his exemption bypass trust without portability, without the exemption going down, would be 15,600,000. His estate tax 11 million. So I've covered portability quite terribly, I might add. If you send me an email that says RE portability, has nothing to do with mushrooms either, by the way. That is, and then we went over annual gifting, which is you can gift annually. If you don't have enough in 529 plans for your children, and you're not doing annual gifting of $15,000 a year to a 529 plan for all those cute children, the younger the better, then something's wrong. You should be doing that. So that's the annual gifting. Remember, that saved them a whole lot, depending on how many children they have. We have some clients with over 100 children and grandchildren. Can you imagine that? 100 children and grandchildren. If Bob and Mary would only have 25 descendants who could have these annual crummy powers, then there would be no problem, except that they would have to deal with 25 descendants. Okay, so we covered the discounted gifting. We did not cover life insurance. We could cover it some other time. And then we covered make a big gift and make a big installment sale. So that's the Estate View software. If you're a client of our office, you can have it for free because we know you'll never use it. If you're a friend or colleague, not so free, $79.95. If I could only sell 1,000 of them, I might recover part of the cost of setting it up, but it's been a lot of fun. All right, now I have a lot of questions here, and I'm very pleased that I got to page 26 of the PowerPoint. I just want to mention before I answer these questions that we have one more slide, or one more spreadsheet. And this spreadsheet is the Qualified Personal Residence Trust, and they were going to take that away because the Qualified Personal Residence Trust is a trust that is disregarded for income tax purposes. And what Dorothy could have done in The Wizard of Oz before the house flew off was, Dorothy, by the way, if you don't have a screen, a monitor that you can, like a touch monitor where you can make things bigger and smaller, you really should consider it. They're about $200 now and really indispensable when you're clumsy like me. So here I could put my home into a Qualified Personal Residence Trust. So here, how does that work? Well, my home is worth $1.9 million, and it is growing in value at 3% a year. Let me mention that until the last 2 years, residences typically have not been a good investment. And now, because they've gone so far up in value in the last couple of years, a lot of people are going to put an inordinately large part of their net worth into more square feet than they need. And I tell the young doctors when I speak at their residency programs, if you think you need more than 4,500 square feet to be happy, then please go see a psychologist, not a realtor, because your home is usually not a great investment. Why? Because when you look at the studies, and the study says the median home in your community has gone up by 3.5% a year, and you get to live in it. Well, guess what? Your home is not the median home. The median home is 20 years old every year. Your home gets older every year. And what happens when it gets older? it gets worth less. And the median home never needed a roof, never needed plumbing, never needed to add to air condition excess floor space. So the stock market, a reasonable allocation of stocks placed in the market, which has grown at the average rate of 7% a year, will beat the pants off of your house. Not to mention that it's less of a frustration and an expense and easier to divide in a divorce. All right. Going back to, though, thank you for letting me go on that tangent. That's what I like about the free webinars. I don't feel obligated to bring value, as you can see. But anyway, this home is worth $1.9 million. They didn't listen to my advice. They bought a big home. And the first 8 years, they get to live in it without paying any rent. And therefore, the gift to the home for this married couple, their ages 74 and 75, the gift of the home was worth $556,000. So, I mean, $656,000. No. 2,000,004. It's discounted to 971,000. So, it's less use of their estate tax exemption than it would have been. We're taking two discounts here: a partial interest discount and a fact that the heirs can't use it for the first 8 years. And I think that this discount is exaggerated. Let me go to something more reasonable, and let's say that they have 14 years free use of the home. Okay, now what happens? After 15 years, the home is out of their estate for estate tax purposes, and they start paying rent. The rent reduces their estate. So in year 20, they've paid $266,000 worth of rent. That has grown to $1,487,000. So now on death, they have $4,900,000 out of their estate. They use $971,000 of their estate tax exemption. The estate tax savings, $15 million. And they didn't have to change anything about the way they live. They didn't have to do anything complicated. So the Qualified Personal Residence Trust, the problem with it is you're only getting that 3% growth out of your estate. It's not necessarily as good as a stock and bond fund, but it's easy, and it's something that we almost lost. But then here's the flip side, and this is what we just added to this. So most of you have not seen this addition that Brandon made. And we thank Brandon, and we thank some clients for asking Brandon about it. So the client said, what does this do on the income tax side? Because my children will not get a stepped up basis when I die. They're going to pay a higher capital gains rate, and that may be the case. So Brandon decided that the possible income tax hit would be $700,000 when the home is eventually sold, but the estate tax saving is $1.5 million. So the net savings, $879,000. So you're getting that spreadsheet. And finally, if you've never used a spreadsheet before in your life, guess what? You can finally use a spreadsheet because you don't have to put numbers in. You toggle on and toggle off. In the office, they call that Allen proofing it, because I don't know how to use a spreadsheet. So I just know how to tell 14-year-olds what to put on a spreadsheet. And the key is to do things one step at a time. All right, Kelsey, if you're listening, I've lost my questions bar. I know it's here somewhere, and I know a lot of jokes about bars, but not a lot of jokes about question bars. Where did my question bar go? I click there, and oh, somebody said they enjoyed my jokes. Must have been my mother. Okay, let's see. Why do I unlink that? Oh, there they are. Okay, now I'm going to share some questions with you. Okay, what about capital gains tax increase? Well, there were not enough votes. Senator Sinema would not vote for a capital gains increase, so there is no capital gains increase on the table right now. All right. is taxation of capital gains inside of an ETF going to be taxed per Wyden's proposal? I don't know. I'm sorry, but I don't think Wyden's proposal is going to get off the ground. Okay, it's been proposed that the expansion of the 3.8% net investment income tax will apply to all trusts and estates regardless of income level. How does this affect a grantor trust? Well, a grantor trust, so I set up a trust for Marcia and my children, and it has $20,000 of income, and because it's taxed on our Form 1040, that will be added, and we will pay the net investment income tax. The trust will not pay it. The bad news is we have to pay it. The good news is that the trust doesn't have to pay it, but there's another alternative. You saw that cute little girl who happens to be the smartest, cutest, most wonderful, amazing 3-year-old who was ever born. If I give her name is Ava, if I give Ava a power to withdraw assets from a trust I set up, and I draft it correctly, and she has 30 days to withdraw the assets I put into the trust. After those 30 days, she no longer has that withdrawal power, but she and my children, my grandchildren, and my wife are beneficiaries of that trust. There's a trustee other than my wife. That trust can be what you call a Section 678 trust. $678,000 is probably what it's going to cost to send her through college, by the way. So that Section 678 trust will be taxed not to me, not as a separate entity, but will be taxed to Ava. And Ava will have less than $400,000 of income, or is it $250,000 for a single person? So she will not be subject to the 3.8% Medicare tax. So here's what I could do. I could set up a management company to operate my law firm, because believe it or not, it takes some management to operate a law firm. Management company could receive an arm's length management fee from our law firm. And Ava might own part of the Ava's 6 and 678 trust might own part of that management company. So that income, instead of ending up on my return, could end up on Ava's tax return and be taxed at her low bracket and qualify for a Section 199A 20% income tax deduction. So if they don't kill the 199A deduction, and they do this to the 3.8% Medicare tax, we're going to be able to set up a lot more Section 678 trusts. Now, that Section 678 trust, tax to Ava, could buy her a house someday when she goes to college, and then when that house is sold, it can take advantage of her $250,000 exemption, even though she may never get a dollar from that trust, because that trust could be used for my wife, Marcia, to buy us a vacation house. But then I would have to pay rent to stay there, and I probably wouldn't even be invited. So I hope that answers the question. Okay, next question. And by the way, we have 4 minutes left, and I promise, because we try to keep this to an hour, if I go over the hour, I will not say anything useful after the hour, because then you won't feel like you missed anything. Okay, the taxation of unrealized gains might be compared to intangible personal property investments that we used to have here in Florida. Yes, that is correct. Can you compare and contrast the SLAT and the bypass trust? Well, the bypass trust is only formed on death, traditionally, and will have to pay its own taxes. The SLAT, is formed while I'm alive, and I will pay the taxes for it. But we used to call the SLAT a lifetime bypass trust until Marty Shinkman started calling them SLAT. So that's what we have to call them now, even whether we like the name or not. That's just the rule in our profession. Okay, I missed the start of the presentation. Can you review the latest House and related proposals for the new act? Yeah, no estate tax increase, no changes to the gift tax, no changes to grantor trusts. All the things we told you to worry about were completely for naught. But thank heaven you got interested and got your estate plan done, because it's still important, because your assets are going to be worth more and more and more. Okay, back to the Forbes article. Can you get into more detail on age limits, consumption requirements, and tax of fraternities? I don't know about any of those things, but I can bring Brandon next week, and he probably knows about all of those things. Okay. Should call Scott Zarrett at the CPA Academy and present for them. Scott will be tickled that you said that. Scott and I are friends, and I enjoy presenting for the CPA Academy on occasion, but only when he invites me, which isn't all that often. Okay, how can I get the software? Just put RE software on the RE line, and Kelsey will be glad to send you the software, because she only gets paid if we sell the software. Otherwise, she works for free. There's some days where she has to sleep in her car. So I hope you buy the software. All right, I have an ILET that allows additional assets. Is there an issue in donating? There's no issue in donating assets to the ILET. Now remember, if I set up an ILET, Marcia's the trustee, she might decide, hey, forget the kids. We don't even like them in the first place. Let's just put it all to charity. And then if she gives it to charity while I'm living, I get the charitable income tax deduction. So you do have that. Okay, somebody says, I love the humor. Obviously, you don't have good taste, but thank you very much. I try to keep it somewhat interesting. Gift split on funding the SLAT. Do you have many clients with gift remorse? Okay, those are two great ones. I put $3 million in the SLAT. If Marcia is unlikely to withdraw from the SLAT, because if Marcia has a net worth of $20 million, and I put in $3 million into the SLAT, if she is unlikely to draw from the SLAT, then I can split the gift with her, which means that she can file a gift tax return saying half of what went into that SLAT came from me. Alan only used $1.5 million of his exemption. And that can be important. For example, if I put $15 million into an LLC and I transfer that to the SLAT, and I say 10 million gift reported on a gift tax return, IRS comes and says, no, Mr. Gassman, $15 million gift. Then I go to Marcia and I say, let's split the gift tax. She can file a late gift tax return. Then it's considered to come $7.5 million from each of us if she is unlikely to reach into the trust. So how do we make it unlikely? Number one, she's worth $20 million. Number two, the trust says that she can only withdraw from it if needed for health, education, and maintenance after considering her other assets. So do you make the trust tight like that, where she could split the gift, or do you make it loose? And we can talk more about slats next week if you like. But that was a really good point to bring that up. All right. And then gift remorse. Yes, clients do sometimes get gift remorse. And it is important. We run a lot of spreadsheets for a few clients to show them, here's what's going to happen if your assets grow fast, if your assets go slow. We never want to let you run out of assets. And that's why for many clients, we put in what we call a backdoor. And the backdoor, there could be two different types of backdoors that we particularly like. One backdoor is we put the trust in Nevada. We favor Nevada. South Dakota is also very good. The way the state law and the estate tax law go together, you could give your friends who are trust protectors the power to add you as a beneficiary of the SLAT if your net worth ever goes down below an unexpected level. So you could spend down your assets or find a way for your assets to go down to that unexpected level, then have them add you to the SLAT. Secondly, you could give what we call an independent trustee the power to give all the SLAT assets to the spouse, and then the spouse can put them back in joint names. So yes, there is gift remorse from time to time, especially when there is estrangement in a family. I will tell clients, you know, you've got a happy family, you've got 5 great kids, they aren't all married yet, there's a chance of estrangement. Let's build in flexibility where if you got estranged, heaven forbid, from a child, you would be able to have a trust protector exclude them or give your spouse a power over the trust. That's another advantage of the SLAT. Quite candidly, your chances of getting estranged are less if you haven't irrevocably given them their inheritance. So estrangement happens a lot more often than people think it does. When you go to a party and say, how's your daughter? The client, your friends don't say, oh, terrible, we're estranged. They go, well, she's doing pretty good. And then they change the subject. So, all right. Now, what about the kitty tax? Yeah, I was just kidding about that. There is no tax on children or cats. Actually, this is a good question. What about the kitty tax causing the investment income to be taxed at the parent's tax rate? Yes, there is a kitty tax, and over $13,000 of income for a child under a certain age. I think it's 23, 22. I don't have my PowerPoint slide to make me look smart. The income over $13,000 is taxed at the child's level. Now, that does not apply for the 20% Section 199A tax savings. The kitty tax is not an issue there. It will probably apply for the 3.8% tax, but we don't know yet. We're not sure yet, but as it's presently drafted, it may throw water on my idea of the 3.8% tax. But if the child provides more than half of their support, then the kitty tax doesn't apply. So if you put $500,000 into a 678 trust, and then the 678 trust pays more than half of that grandchild's support, then the kitty tax will not apply. At least that's the position of many good artists. So I have a question for you, and that is, I started this webinar series on a Saturday, I don't know how many weeks ago, expecting 30 to 40 people, and quite honestly, we got maybe 300, and I was surprised, and I just had a great time with it. And I think it's a flash in the pan because it's based primarily upon people who are so concerned about the estate tax, and now that concern is going to go away. But I'm going to continue the webinar series because I've just enjoyed it immensely. We'll start breaking out into talks on income tax planning. I want to talk about whether you should convert your IRA to a Roth IRA. I want to have friends come along. So if you think it's a good idea, for some reason, Saturday at 11 works well for me because I typically work Saturday morning until just afternoon, and then I try to come home. Sometimes I don't. Usually I do, or at least a lot of times I do. Saturday 11 works well. I apologize to my Jewish friends who can't show up Saturday at 11. Maybe we'll do a Sunday at 11 sometime. I'm sorry if you're from California and you like to sleep late. I personally don't sleep late. But in any event, if you have ideas for this, I'd love to know what they were. If you'd like to join us sometime and give a comment or a question, send me a video. Maybe I'll play it for you and then answer your question. Have a fantastic, great rest of your weekend. And I hope that you'll use this information to follow through, to help your family, and to help others. Kelsey, thanks for finding my question bar. And Ava, thanks for appearing today. We'll be sending you your appearance fee that you can put into your IRA and invest to receive, I hope, a 7% rate of return. Thank you very much.